Hello everyone and welcome to my channel. This video continues with the 12th and final part of the series. How does money and our global economic cycle work? It starts right after the intro. Stay tuned.
Insights for the informed investor.
What are EBIT, EBITDA, and EBITDA? These three acronyms describe intermediate measures in the income statement. They help illustrate a company's operating performance. EBIT stands for earnings before interest and taxes. This metric corresponds to a company's operating profit. As the name suggests, it represents the profit generated before deducting interest and taxes. EBITDA stands for earnings before interest, taxes, and amortization. What is the difference between EBIT and EBITDA? The difference lies in the fact that EBITDA presents the operating result without deducting scheduled amortization. In addition to amortization, the depreciation of tangible assets is not shown. The last metric, EBITDA, stands for earnings before interest, taxes, depreciation, and amortization. This figure considers all the factors described above, including scheduled depreciation and the impairment of tangible assets. What is the purpose of these metrics? The goal of these metrics is to eliminate unpredictable and non-recurring impairments. This allows for a closer approximation of a company's operational cash flow. To help you understand the significance of this metric, let's consider an example. Imagine a company has an EBITDA of $14,347 million in a given fiscal year. This is composed of the following components: operating profit of $8,450 million, scheduled depreciation of tangible assets amounting to $5,001 million, intangible assets totaling $780 million, and finally, a goodwill impairment of $116 million. As you can see, these metrics offer the advantage of providing a clear picture of a company, which can facilitate investment decisions. It is important to note that these metrics are not defined by IFRS, International Financial Reporting Standards. The difference between basic and diluted earnings per share. You should understand this difference when making investment decisions. Basic earnings per share indicate how much profit the company generates per share outstanding. In contrast, diluted earnings per share also consider the so-called common stock equivalents. What does dilution mean in this context? Dilution refers to the reduction in earnings per share caused by the assumed increase in the number of shares outstanding. How can the number of shares increase? It's simpler than you might think. For example, it can happen through a capital increase. Which segment generates the highest profit contribution? This is a crucial question that may be necessary for many other decisions. Not all companies are required to provide segment reporting. Only those companies whose shares or debt securities are publicly traded or have applied for such securities to be traded on a stock exchange are required to conduct segment reporting. This can be helpful for investors in many ways. It allows them to gain insight into which business areas are generating the most profit. Additionally, investors gain an overview of all areas of the company, enabling them to make informed decisions. But how is segment reporting presented under IFRS? Under IFRS, segment reporting must follow the management approach. This means that a company's data is presented in a way that is used internally for management purposes. This segmentation applies not only to the division of segments, but also to the accounting method used. For example, if internal management is based on figures according to German Commercial Code, HGB, this also applies to segment reporting. The rationale behind this is that an external reader, such as an investor, should gain insight into the figures used internally for decision-making. This allows an external reader to make well-informed decisions. Furthermore, segment reporting should only present the key segments. Those segments that do not have a significant impact are not included. This ensures that a company's success is measured based on the most important figures. In the context of IFRS consolidated financial statements, the term impairment frequently appears. What does this term mean? The significance of impairment. IFRS establishes the following rule. All long-term assets must be examined for any indications that their value no longer matches their carrying amount. An asset is considered overvalued if its book value exceeds the discounted cash flow that it can generate. When there are indicators necessitating such an evaluation, impairment tests or other unscheduled write-downs must be performed. The reasons for these calculations can vary widely. For instance, technological obsolescence, competitive products, or insufficient returns may prompt these tests. As you can see, an impairment can occur quite swiftly. However, over time, it is also necessary to assess the recoverability of goodwill. Goodwill is not easily quantified, making its assessment more challenging. According to IFRS regulations, an impairment test must be conducted annually. It should be noted that goodwill is only valuable in conjunction with parts of the group. Consequently, it cannot be easily determined. Now you have the basics to read a consolidated income statement according to IFRS correctly. Alongside this aspect, the consolidated balance sheet must also be interpreted. The tools you need for interpreting the consolidated balance sheet will be introduced in the next chapter. What is the valuation basis for the consolidated balance sheet? How is accounting and valuation conducted? This process is simpler than you might think. Accounting and valuation are based on the assumption that the business will continue in the next fiscal year. If this assumption cannot be maintained, changes to the valuation basis must be applied. This includes determining going concern values. Once the assumption is made that the business will continue, all assets are valued at their acquisition or production costs at the time of acquisition. In subsequent fiscal years, the valuation is based on various criteria. Tangible assets, such as machinery or buildings, are regularly depreciated. Financial instruments are generally valued at their fair value. IFRS also specifies non-depreciable assets, including trademarks and goodwill. As such, they are not subject to scheduled amortization. As described in the previous section, these assets are only periodically tested for impairment. Additionally, customer receivables are recorded at the amount expected to be received. Inventories are also tested for impairment based on market prices. What leads to changes in assets and liabilities? What causes changes in assets and liabilities? Changes in a balance sheet item can result from various factors. For example, the acquisition of debt or equity can alter the relevant item. Another cause may be the execution of a write-down or write-up. One thing is clear. Without analyzing the other components of the financial statements, you cannot fully understand the changes in the consolidated balance sheet. Most companies use double-entry bookkeeping. To truly understand what has happened, you need a deep insight into the company. This understanding comes only after a thorough analysis of the entire balance sheet. For example, an increase in inventory may coincide with a decline in revenue due to reduced receivables. In the consolidated balance sheet, activated goodwill is often mentioned. What does this actually mean? Activated goodwill. In the balance sheet of a parent company, the acquisition of additional companies is recorded at the acquisition cost of the company, noted under investments in affiliates. However, in the consolidated balance sheet, these shares are not recorded as such. Instead, the acquired assets and liabilities are recorded at fair value. Goodwill is the amount by which the purchase price paid for a company exceeds the fair value of the acquired assets and liabilities. Goodwill is continually tested for impairment over time to provide investors with a degree of security. Associated companies and joint ventures. Have you ever looked at a balance sheet and wondered about the difference between these two types of enterprises? An associated company refers to a situation where a subsidiary or parent company holds shares in another company but does not fully own it. The shareholder can exert significant influence over the other company, but cannot directly enforce decisions. Such influence is typically granted with a voting share of between 20% and 50%. Associated companies are included in the consolidated financial statements. They are valued based on their proportionate equity, also known as the equity method. If an associated company retains earnings, the equity value increases. Conversely, if profits are distributed, the value decreases. A joint venture differs significantly from an associated company. One key difference is that a joint venture is jointly managed by multiple partner companies. This means that all decisions affecting the venture must be made collectively by all partners. Deferred taxes. In the business world, the term deferred taxes frequently comes up, and they are increasingly found in financial statements. How should you assess these, and what do deferred taxes indicate? Generally, it should be noted that the values in an IFRS financial statement often differ from those allowed for tax purposes. These differences can lead to future tax liabilities, deferred tax liabilities, or tax assets, deferred tax assets, that must be included in the consolidated financial statements. The treatment of these two types of taxes is crucial. Deferred tax assets are recorded against loss carry-forwards. For deferred tax liabilities, companies have more flexibility. Since these are tax obligations, they must be recognized. The fundamental principle of accounting is to account for potential losses. The company should reflect a worse situation than it actually is. Are reserves distributed? In the balance sheet, you will frequently encounter the term reserves. Many people assume that reserves can be distributed. Is this true? It depends on the type of reserves. If the reserves belong to the parent company within the group, they can indeed be distributed at the company level. However, this is rare. Besides reserves, provisions also play a crucial role. Why are provisions needed? First, it should be clarified what a provision is. A provision represents a liability that is not yet definite in terms of its timing or amount. Provisions are made for various purposes, such as legal risks, tax liabilities, or pension obligations. When provisions are made, a variety of assumptions are usually involved. Therefore, provisions also provide some flexibility in accounting. In the financial industry, there is a phenomenon known as the big bath. These are companies already burdened by restructuring costs that use this situation to create additional provisions. What's the point? Simply put, they aim to push an already negative result even further into the negative. The consolidated notes provide insights into such strategies. The notes must include accounting and valuation methods for provisions. Additionally, each group of provisions must include details regarding uncertainties related to amounts or timings. Alongside the consolidated balance sheet, the cash flow statement plays a crucial role. It provides insights into the company's liquidity. The term cash flow frequently appears in the context of the cash flow statement. What does it mean? Cash flow. In practice, the term cash flow is often used inconsistently. Generally, cash flow is understood as the change in liquid assets resulting from operating activities. However, IFRS regulations have a slightly different perspective. According to IFRS, cash flow refers to the total change in liquid assets. The cash flow statement thus represents the change in financial liquidity. What exactly is financial liquidity? It includes not only normal cash, such as cash in hand or demand deposits, but also cash equivalents. These are defined as short-term, highly liquid financial investments. An important feature of these equivalents is that they are subject to minimal risk of value fluctuations. Other securities that do not have these characteristics cannot be classified as cash equivalents. Now, let's return to the key figure, cash flow. What does it actually indicate? To understand this, you should first build an understanding of how cash flow is calculated. The starting point for operating cash flow is the sales revenue. From this, payments for procurement, administration, production, and distribution are deducted. The operating cash flow thus shows how the financial liquidity from the company's core activities has been increased. If this cash flow is negative, it indicates the extent to which the company's operations had to be financed from other sources. In business management, a positive cash flow is also referred to as a company's internal financing volume. In such cases, the liquidity generated from the operating activities can be used for distributions and repayments. To calculate cash flow, the indirect method is usually employed. This involves starting with the annual result. Non-cash expenses, such as provisions or depreciation, are added to this result. Conversely, non-cash income is deducted. This gives you the operating cash flow. Besides the indirect method, there is also the direct method, which is rarely used in practice due to its high effort. Besides operating cash flow, there are other cash flow metrics you should be aware of. One such metric is the cash flow from investing activities. To understand this cash flow, you should first get an overview of a company's investing activities. This includes both payments for tangible and financial assets and other intangible assets, as well as receipts from the direct sale of these assets. For example, if subsidiaries are bought or sold, this will always affect the cash flow from investing activities. Here, the purchase or sale price is recorded. In addition to this cash flow, there is also cash flow from financing activities. This includes receipts from capital increases, payments to shareholders, and the taking out and repayment of loans or bonds. Treasury shares are presented as a deduction from equity. Consequently, the purchase or sale of treasury shares must also be reflected in financing activities. In this context, it is important to consider the impact of currency differences on the cash flow statement. Financial assets are always exposed to the risks of various exchange rates. Changes due to exchange rates must be separately reported in the financial liquidity fund. In addition to the mentioned metrics, there is the free cash flow at the end. This cash flow is not explicitly defined in IFRS. It is actually a general term for various business metrics used to measure a company's financial strength. In practice, free cash flow is usually determined by summing the operating and investing cash flows. The amount remaining to repay debt or make distributions to shareholders is the free cash flow. If you've enjoyed the video so far, don't forget to like it. Subscribe to my channel and activate the bell to give the channel added value and support my channel for free. Equity changes. For a group and its shareholders, it is crucial to understand how the equity of a company has changed. According to IFRS, there is no explicit subdivision of equity. The guidelines for subdivision derive from corporate law regulations applicable in the country where the reporting entity is based. For listed companies in Germany, this is typically the Stock Corporation Act. Equity usually consists of paid-in capital and earned capital. According to IFRS, the group equity also includes separately reported interests of non-controlling shareholders. This means that interests held by third parties must also be included. The paid-in capital of a company typically includes the subscribed capital of the parent company and capital reserves. Subscribed capital may have arisen from issuing common or preferred shares. This is important for investors, as different types of shares confer different rights. Additionally, there may be restrictions on distributions. All these factors must be considered. The group notes therefore also specify the rights associated with each type of share. Earned capital in a group consists of retained earnings and separately reported reserves. In these separate items, depending on IFRS regulations, individual components of results are included. Some of the other results accumulated in these reserves are to be transferred to the annual result in subsequent years. Other parts of the other results, however, remain permanently in the reserves. If the group has conducted transactions involving its own shares, these must be directly recorded in the reserve for treasury shares. What goes into retained earnings? These include the accumulated and retained annual results. In addition, any other results that do not need to be reported in a separate reserve are included. Now that you have a basic understanding of how equity is composed, let's move on to the changes. How does equity change? What influences cause equity to change? Changes in a company's equity reflect increases or decreases in net assets. Equity changes can essentially arise from two factors. The first factor is the net result. In addition, capital transactions can lead to changes in a company's equity. These should alter the directly paid-in capital, such as in the case of capital increases or reductions. Additionally, you should note the relationship between equity changes and comprehensive income accounting. In comprehensive income accounting, the total result is derived as a metric. This represents a change in equity. In the equity change statement, different components of the result are assigned to specific equity items. In equity accounting, it is often noted that treasury shares are deducted from equity in the group financial statements. What is the reason for this? Treasury shares refer to shares that the parent company itself has acquired within the group. The question arises as to why the parent company acquires its own shares. The reasons are varied. On one hand, the parent company may acquire its own shares to effect a capital reduction. On the other hand, it may do so to prepare for a distribution replacement. Typically, the extent of shares the parent company can acquire is restricted. In Germany, there are relevant stock corporation regulations for this purpose. Treasury shares acquired by a company are not considered assets in the group financial statements, according to IFRS. Instead, they are seen as a return of capital. Therefore, they must also be represented accordingly. Treasury shares are recorded in a specific reserve within equity. If the treasury shares are sold over time, this is considered a capital increase. Next, you should consider the topic of restatements. How do these affect equity? Restatements involve changes in accounting methods and corrections of significant errors. To compare two consecutive financial statements, accounting methods must generally remain consistent. Changes in methods can only be made if required by a new standard or interpretation. This might include decisions such as no longer valuing real estate at historical cost. To account for changes in accounting methods, retrospective adjustments are usually made. When is an error present that requires a change? An error occurs, for example, if an accounting regulation has not been correctly applied. Additionally, it may be the result of multiple incorrect calculations in the past. Consequently, a retrospective adjustment must be carried out. How is such a retrospective adjustment made? This involves making a neutral adjustment of assets and liabilities to the beginning date of the previous year. The determination of adjustment amounts is crucial. They must be calculated so that the new accounting methods were already applied, meaning past financial statements would have been correct. The impact of such an adjustment on each equity position must be detailed in the equity change statement. Furthermore, a third column must be added to the group balance sheet. The notes to the financial statements must detail the impact on each item of the group financial statements. Finally, the following question often arises: does equity really correspond to the company's value? Some people confuse two different aspects here. A company's value is not only measured by its equity. On the contrary, the company's value is determined using the so-called income approach. This method is based on the assumption that the company will continue in the future periods. The same applies to equity, but it is slightly different. Equity does not correspond to the company's value. So how do differences between equity and company value arise? The differences mainly result from self-created intangible assets. These include customer base, market strength, and competitive advantages. In accounting, these values do not result in tangible figures. However, they can be easily considered in a company valuation. Additional differences arise from IFRS valuation requirements. These are usually due to some items being valued at historical cost. As you can see, equity is a crucial figure when analyzing your balance sheet. However, you should be aware that equity does not automatically provide a conclusion about the company's actual value. This is determined in a different way and includes many assets that primarily have no tangible value. Finally, when reviewing an annual financial statement, you need to examine the group notes. These usually contain information that can help you better understand the balance sheet. What can you find in the group notes? And why are the components of the notes of critical importance? The Consolidated Financial Statement Notes. The Consolidated Financial Statement Notes primarily present the accounting principles. By specifying these principles, it becomes clear which standards, IFRS, HGB, the respective group applies. Additionally, the scope of consolidation is defined, and the accounting and valuation methods used are outlined. These are core points that provide a more detailed insight into the actual contents of the balance sheet. Among other things, information is provided on the exercise of optional rights. It also facilitates an understanding of changes in the consolidated balance sheet and income statement. Furthermore, adjustments may occur in the presentation of these changes. Many balance sheets based on IFRS are grounded in broad economic principles, which are highly interpretative in application. Consequently, It is advisable to provide an explanation in the consolidated financial statement notes regarding this. Regarding the accounting and valuation methods, it should be noted that these must be applied consistently over the years and can only be changed if a new standard is established or an appropriate interpretation is required. As mentioned in the previous section, such changes must always be applied retroactively. In the consolidated financial statements, you will find, in addition to these two pieces of information, explanations concerning individual items of the financial statements. These explanations provide information on the composition and reasons for significant changes in specific items of the consolidated balance sheet. Additionally, they offer insights into changes in the comprehensive income statement and cash flow statement. The consolidated financial statement notes also include a presentation illustrating the development of intangible assets. Furthermore, the explanations provide information regarding financial liabilities. Moreover, there are explanations related to pension provisions, financial instruments, and income taxes, all of which play a crucial role in the balance sheet. Thus, the main focus when reviewing the notes is on supplementary information. What important supplementary information does it provide? Part of the explanations is covered by the details on so-called contingent liabilities and other obligations. These 2 points refer to business transactions that are partially uncertain and therefore do not yet appear in the balance sheet. The occurrence of these liabilities may lead to a reduction in profit, for example. The disclosure of these contingent liabilities and other risks is mandatory. The reason for this obligation is straightforward. Addressees of the financial statements can gain an overview of the overall situation of the company through these risk disclosures. Besides this crucial information, the consolidated financial statement notes include information on various segments. These are also known as segment reports and have been mentioned as terminology in previous sections. This provides investors with insights into the company's key business areas. When companies prepare an IFRS consolidated financial statement according to FAR 315A HGB, they must include additional disclosures that the German legislator considers important. These disclosures include personnel expenses, the number of employees, executive compensation, and the corporate governance statement. Besides these aspects, the presentation of the development of intangible assets and property, plant, and equipment plays a crucial role. What can you deduce from such a presentation? First of all, you should remember that the presentation of the aforementioned values is done on a gross basis. This means that the development of acquisition costs and accumulated depreciation is shown. Now, let's address the depreciation item. What is its significance? First, you should understand what is included in depreciation. In addition to scheduled depreciation, this item also includes expenses due to impairments. Furthermore, under IFRS, every company must assess at the balance sheet date whether there are indications of impaired assets. If indicators of impairment are present, an impairment test should be conducted. It can also occur that an asset is deemed overvalued if its book value is no longer covered by the discounted cash flow. Special complexity arises from assessments related to the recoverability of goodwill. This assessment is not straightforward and requires an annual test to evaluate the impairment of this intangible asset. In addition to depreciation, the provision schedule is of critical importance. This schedule shows the significant development of each major category of provisions. High releases, for example, indicate that there are estimation uncertainties. Many investors understand these 2 points but struggle with pension obligations. How are these calculated? Long-term pension obligations are only recognized under IFRS for defined benefit plans. These are pension obligations where the employer bears the financial risk, not the employee. Apart from this, there is also the defined contribution pension obligation. This is calculated as the present value, accumulated using the current single premium method. The present value calculation is not straightforward and depends on numerous demographic and financial assumptions made at the balance sheet date. If a settlement occurs, an interest rate that reflects the yield on high-quality fixed-interest industrial bonds must be used. If a company holds pension assets, The return on these assets reduces the pension expense. Currently, the return on pension assets is no longer based on individual estimates, but is standardized to an interest rate used for discounting pension obligations. The valuation assumptions are updated annually. Consequently, actuarial gains or losses are included in the other comprehensive income as they arise. These actuarial changes can vary from year to year, and immediate recognition in other comprehensive income makes sense from a financial analyst's perspective. This approach ensures a more transparent presentation. To understand pension schemes reflected in the consolidated financial statements, you need to know one crucial point. The pension obligation reported in the balance sheet is always a net liability. This size results from a net presentation between the accumulated present value of pension obligations and the actual pension assets. It should be noted that not all assets are eligible for offsetting as pension assets. Only plan assets can be offset. The IFRS standard sets strict rules for an asset to be considered as plan assets. What is this regulation? Only assets that can be legally separated from the productive assets of the respective group and are purpose-specific can be considered as plan assets. This means that such assets may only be used for financing pension obligations. Another important requirement is that the assets must be protected from the claims of third-party creditors in case of insolvency. As you can see, you can deduce a lot from pension assets, but this requires specific knowledge that not everyone may have. There is a good reason why pension assets must be purpose-specific, to protect the assets from third-party creditors in case of insolvency. Have you ever wondered when groups must repay debts? Many people likely ask this question. The answer can be found in the consolidated financial statement notes. These notes include information on the maturity of debt. This data allows conclusions to be drawn about the company's future obligations. By examining this, you can ultimately assess the company's liquidity situation. In addition to this point, you will also learn about the group's tax payments in the consolidated financial statement notes. Have you always wanted to know how much tax a group pays? Then you just need to look at the notes. They include explanations on income taxes. These explanations also contain a reconciliation from the expected tax rate to the effective tax rate. This means a reconciliation from the expected tax expense to the actual reported tax expense. The reconciliation of the tax rate can be done in two different ways, either using the tax rates of the respective company or calculating a weighted average of all tax rates used locally in the group. The effective tax rate is derived from the group's comprehensive income statement. Two values are particularly important here: the reported income tax expense relative to the income before taxes. However, discrepancies in the calculation can occur. How is this explained? The explanation is much simpler than you might think. Discrepancies often arise from tax-exempt income or non-deductible expenses. It may also be that there are unrecognized tax assets from loss carry-forwards. Additionally, the notes include information on the risks of financial instruments. Companies are required to provide reasonable disclosures about both the nature and extent of the respective risks. Ultimately, these disclosures should provide insight into the financial risks, particularly liquidity risks, market risks, or credit risks that a company faces. Also, disclosures must be made on how the company manages these risks. For financial statement readers, this information is of crucial importance as it significantly impacts the future development of the company. Market risks are usually divided into two major types: currency risks and interest rate risks. Groups are required to provide sensitivity analyses in the consolidated financial statement notes that illustrate these risks. These analyses include the future impact of these risks on financial results. Moreover, liquidity risk can only be assessed if disclosures are made regarding the contractual maturities of financial liabilities. Therefore, companies are also required to provide these disclosures. Finally, let's mention the management report. What can you learn from it, and why is it important? First, let's cover the basics required for the management report. According to commercial law regulations, all companies must prepare such a report unless they are exempt from this obligation. It is a standalone reporting tool that must align with the consolidated financial statements. So, what is the purpose of the management report? In a management report, management accounts for the use of resources in the past fiscal year. In addition to analyzing business performance, which includes the results, statements are made about the company's situation. Additionally, opportunities and risks for the company are highlighted. The management report will contain many forward-looking components. Thus, it plays a significant role in any potential investment decisions. The addressee should receive all relevant information for decision-making. Of course, this information should be reliable. The focus is on the overall economic assessment of the group. It also aims to provide a better understanding of the company's asset, earnings, and financial situation. All these aspects must adhere to certain principles. These are outlined in the so-called DSR, an abbreviation for German accounting standards. Section DSR 20 provides all the regulations that must be followed. For a complete, reliable, balanced, clear, and comprehensible reporting, an appropriate level of information detail must be ensured. What does this mean? It means that the extent and detail of the management report depend on various factors such as the business activity, size, and capital market orientation of the group. The structure of the management report is quite simple. The DSR also provides a suggestion in this regard. This is not a definitive proposal, but can be followed to ensure compliance. To ensure proper reporting, the following key components should be included in the management report: business performance, the overall financial situation, earnings, and cash flow. Furthermore, the development of non-financial performance indicators and an assessment of the company's future perspectives should be provided. Regarding non-financial performance indicators, companies should disclose key figures such as those related to the environment, employees, or social aspects. This is particularly important for stakeholders who may not be interested in purely financial aspects, but are concerned with other key factors. In summary, the management report serves to assess the overall performance of the company. It provides an opportunity to highlight both positive and negative developments. The primary purpose is to give stakeholders an understanding of the company's position and future prospects. This reporting tool is a vital part of financial communication and must be prepared in accordance with the applicable standards and regulations. This was the 12th and final part of the series. How do money and our global economic cycle work? I hope you enjoyed the video and would be delighted if you would give me a like, subscribe to the channel, and activate the bell. That way you won't miss any more videos from me and will be informed immediately when a new video is published. Thank you for watching the whole video and the whole series, and see you soon.